Forward, let me also invite Saurabh Kumar, Senior Analyst, India Banking and Financial Research at JPMorgan, to take a few questions. Saurabh, morning. This is Reema here. First, if you could lay out your top 3 expectations from earnings this time for the sector.
So I think on the earnings, I think the main question will be how the LDR ratio, credit deposit ratio trends. So we have seen these initial numbers coming out at banks. So obviously the reduction, there has been some sequential reduction which has happened across a few, but I think that will be the main. The second will be basically we do expect some rise in credit costs, especially in the unsecured business. That will be the second thing to watch for. But the biggest number basically, because this is Q4, Q4 is also seasonally strong across banks. I think the guidance or whatever banks can give color on next year growth, loan growth and balance sheet growth will be key, because these banks are now, in our view, going to get priced for growth, because the credit, in our view, for Indian banks remains one of the cleanest in Asia Pacific. So what we're really betting, the investors will really be betting on growth.
So Saurabh, just addressing each of these 3 in greater detail. So first, on the credit to deposit ratio, by how much will it come down by? And is that something which is going to continue? And then even on the credit cost in unsecured lending, what's the increase that we should expect?
So I think broadly for banks where the LDRs were stretched, let's say above 90% one would expect some moderation to continue to happen. But banks where the headroom was there, let's say they were below 90 or below 85, I think there is some headroom for them to kind of accelerate. On credit cost, we think broadly, I mean, depends on each bank, each NBFC, what the exposure to unsecured loans is. But broadly, given baseline, I think 15-20% worsening, which is very near term, could happen on the unsecured book. So that will be the baseline expectation where I think markets will start off with, and will kind of build from there. But I would also point that Q4 is seasonally strong for asset quality in other segments. Corporate is going to be 0 to negative, I think, on MSME and other pieces, things will remain pretty benign. So credit quality is less of a concern for us right now, unless the bank is significantly exposed to unsecured loans.
You know, Saurabh, before these business updates came out earlier this month, there was a lot of talk going about the banks facing some deposit growth challenges going forward. But the deposit growth this quarter has been fairly robust for most of the banks that have come out. Do you see this as a one-off, or do you see these trends sustaining going forward as well?
Yeah, so our view is that, look, given at a macro level, we don't think that deposit at a country level will be a problem. At a system level is going to be an issue. The issue is low-cost deposit. So obviously, CASA growth remains the biggest challenge and the biggest monitorable, because CASA growth is the main constraining factor. But deposit growth, I mean, if you look at the latest prints across RBI, the deposit growth is printing up eventually over a 3-4 year basis. Both credit growth and deposit growth do normalize. Our view is that, look, money is not leaking the country. BOP continues to remain positive. So we are less concerned about deposit. It's just a matter of rates which you pay. And banks had run up, in our view, LDR a bit more opportunistically, given the rate cycle was speaking out. But yeah, on the total deposit growth, we are less concerned. But yes, CASA growth is the main monitorable to our view.
And PSU banks are best positioned on the CASA growth front? And between private and PSUs, I know you won't talk individual stocks, but between private and PSUs, what would you guide investors? How should they think about it?
So CASA growth, obviously, I think it's an issue for the system. I think private banks may do marginally better than PSU banks. But broadly, the thematic we are basically playing is by the corporate banks in India next 3-4 years are going to be great for the corporate banking cycle. Larger private banks run largely balanced businesses between corporate and retail banking. SOE banks tend to be more exposed into corporate banking. So that remains the trade to our mind, that you buy PSU banks for the credit, but stay back for the growth.
And FY25 growth expectations on the loan growth front, what are you expecting?
So we expect system credit growth to be about 13% and the individual banks, depending on the bank, can do 200 or 300 basis points better.
What about the larger private banks, Saurabh? I know you don't want to talk specific stocks, but there has been a lot of these merger-related issues with the largest private lender as well. A lot of these other private lenders, some of the peers as well, have highlighted some challenges. Where do you stand when it comes to larger private banks compared to the mid-sized ones? Do you find value in either of these pockets?
Yeah, so large private banks are on a price earnings, price to book relative to the normalized ROEs and the normalized growth that these banks can generate. To our minds, do look attractive relative to where the other NBFCs and the smaller banks traded. And obviously, these banks, in an environment where deposits are constrained, where you risk some level of, let's say, lower CASA growth, some slightly higher rates on term deposits, these banks will be better positioned in our view. So given the valuations, given the growth, I think your cohort of large cap privates relative to even the market do look attractive.
Pleasure speaking to you, Saurabh. Thanks a lot for joining in and sparing time and sharing your views on the expectations from the banking earnings that are expected this quarter. That was Saurabh Kumar there of JPMorgan. By the way, flashes